How to invest your money. This is a follow-up to my other video about mutual funds. Investing is simple. Decide how much risk is appropriate for you, then buy, hold, and rebalance index funds. So easy, a first grader can do it. And when you invest in index funds, history has consistently shown that you should outperform the vast majority of Wall Street professionals. Now, what you should not do: don't buy alternative investments like annuities, limited partnerships, non-traded REITs, life settlement investments, promissory notes, private equity, etc., etc. 2, don't buy actively managed mutual funds like what non-fiduciaries sell you at full-service brokerage firms. I already explained why in my video about mutual funds. Number 3, do not attempt to buy individual stocks. It's risky, more expensive, and it's a huge waste of time. Now, people have this misconception that they can beat the market averages, and so they pay for services, subscriptions, newsletters, they pay for research, or they go to a full-service brokerage firm, which of course is in the business of selling you expensive products like actively managed mutual funds, annuities, etc., or they go to the independent investment firm down the street or the stock-picking guru down the street who boasts that he's been beating the market for X amount of years. But all you're doing with these people is throwing away your money. The efficient market hypothesis says that nobody can beat the market because of the rapid dissemination of news and information. Everybody already knows the exact same news about companies that everybody else knows. This is not 1990 anymore, when there was no internet and you had to wait until the morning paper arrived to read about your stocks. So today, unless you have inside information, which is likely illegal, you have no edge when it comes to picking stocks. The only thing you're doing is increasing the risk of picking too many loser stocks. And of course, you're also racking up lots of trading costs by getting in and out of stocks. By the way, anyone who claims that they are beating the market, all they are doing is simply taking on more risk. And they did so during a bull market. So basically, they got lucky. But the strategy of taking on more risk backfires big time if you hit bear markets like we saw in 2008. But I see these services where they're boasting that their stock picks for 2013 were up 80%, or somebody will tell me, you know, I'm invested in this mutual fund that has beaten the S&P 500 by 100% since 2007. And so the average know-nothing investor says, gee, the S&P 500 total return index only gained 33% in 2013. I've got to sign up for this service. No. When you examine these services or the fund or whatever it may be, they are not picking blended S&P 500 stocks. They are simply taking on greater risk by picking, for example, volatile, aggressive growth companies like perhaps 3D printing company stocks, which during bull markets, these high flyers soar in value. I mean, if you really want to take on more risk and step into the high roller room, you don't need to buy some expensive mutual fund or pay some guru to pick aggressive growth stocks. Heck, you could buy a double or triple leveraged ETF like SPXL, which gives you triple the return of the S&P 500 index. Or you could buy TNA, which gives you 3 times the leverage of the Russell 2000 index. But the point is, anybody can take on more risk. There is no skill involved in doing that. By the way, I would never recommend doing this because the experts will say never bear too little risk or bear too much risk. Dumping a whole bunch of money in leveraged ETFs or 100% in aggressive growth stocks could devastate your portfolio if the stock market were to decline like it did back in 2008. And the respected experts and scholars will tell you that wealth is achieved the slow and gradual way. All right, so despite the efficient market hypothesis, a lot of people still insist on picking stocks on their own. And in doing so, well, at least they eliminate paying someone to hold their hand, but they still rack up trading costs. And by buying individual stocks, they actually take on significant risk. Now, Longboard Asset Management did a study in which they compiled the returns of 3,000 stocks from 1983 to 2007, which is a huge 24-year period that included the 80s and 90s bull market. And they found, this is amazing, that during this 24-year period, 39% of those 3,000 stocks were unprofitable. Whereas the S&P 500 price return index, which actually doesn't count dividends, it went up 829%. So if you've only got perhaps 10 stocks in your portfolio, there's a real risk that you might pick too many of the wrong stocks. So to compensate, you might decide to just further diversify by investing in perhaps 20 stocks, but then you're racking up more trading costs. And at some point, it's like, well, if you're going to invest in 20 stocks, you might as well just pick an index fund or two. So then you have people who follow the advice, the free advice of people like Jim Cramer on MSNBC's Mad Money. And Jim, he's an expert on stocks. He used to run a hedge fund, but there's an article called Jim Cramer Won't Make You Rich. This article concluded that there's no evidence of any stock picking skills. His picks are neither good nor bad. And again, this is the efficient market hypothesis in action. Stop trying to pick individual stocks. It's like being in a casino at the roulette wheel. Should you pick red or black? I don't know. Nobody knows. Stop playing that game. Instead, buy just a few index funds and be done with it. Now, before you invest in some index funds like VOO and AGG, you need to figure out how much risk to take. Now, there's a few methods. A very rudimentary method is to subtract your age from 120, and then that number tells you how much to invest in the stock asset class. For example, if you're 50 years old and you have a steady job, you might be best suited by putting 70% in VOO and the rest in bonds like the total bond market ETF AGG. There's also some websites that ask you a few questions, then spits out a portfolio. For example, Vanguard has a very simple portfolio selection tool. Rick Edelman has a tool that spits out a more complex portfolio. Now, is Vanguard's simple 3 ETF portfolio better than Rick Edelman's complex ETF portfolio? I don't know. I think there comes a point where all these funds just kind of cancel each other out. Warren Buffett actually recommends for long-term investing a very simple approach of one single S&P 500 ETF like VOO and the rest in short-term government bonds. That's it. By the way, never forget the phrase, when stocks fall, money runs to the safety of bonds. Bonds are and have always been a stock shock absorber. And right now, the experts are saying that fear of a bond bubble shouldn't cause you to abandon bonds. If stocks crash, that's when you will be happy that you diversified and didn't swing for the fences by putting 100% of your money in the more volatile stock asset class. Again, it's about age-appropriate stock bond diversification. Just buy, hold, and rebalance as needed to maintain your stock bond allocation ratio.